Welcome to a thought share on markets as we enter into the festive season for 2024. Wishing all our members a happy season of festivities. In this video, we will talk about a few topics like where are the markets now, what are the positivities that are there which can keep prices up for the market, what are the negativities or the challenges that are expected and that can bring down prices, and what are the actions we can take to ensure good growth or better growth for our investments. Let's start with how is the market now. Compared to 2023, where we had between 30 to 60% returns in the overall market, that is 30 was somewhere in the large cap side, 60 was in the mid and small cap. Mid and small cap was very heated in 2023. Compared to 2023, now the market is kind of slowed down. What was 60 has come down to 20% now in the last 8 months. And if we take precisely Sensex, it is hovering around 15%. There is a likelihood this sideways, the slow move can continue, and probably in 6 to 9 months time, we can have the whole market come to probably a higher single digit, that is close to 10% or little above 10%, 10 to 12% kind of range. So is this a concern? Not at all, because after a very big year, it is bound to have a slowdown, because that's how it adjusts to give an average. So last year when we made 40-50%, and the average market return is between 15 to 16 or 13 to 15 only. So from 50 it has to come to 16. Some years will be weak, some years can be negative also. That said, the whole market is not weak now. There are pockets which are having exuberance, and that size of the places where the exuberance is there is actually small. So the good times of buying anything and making profit is over now. It has become a selective stock pickers market kind of, we can say. So when we are invested into those places, obviously we can make better returns. Why is the market slowing down now? Stock prices are slaves to earnings. That is, only when profits are there, are consistently growing, stock price also will keep growing higher and higher. Something that happened unique last year was, though profits were good, market prices adjusted to the bigger profits, the investors in the market started pushing the stock prices far higher in expectation of similar great results in this year also. That is, if a company had delivered 100 rupees profit and the stock prices have gone up for that meeting that 100 rupees profit, the expectation built that this year the company will be giving 150 rupees, and to that, keeping that in mind, stock prices have already gone up for this 150 rupees profit. But the reality was, the current profits, current year 2024 first quarter results, whatever came now, instead of that 150, it came 130. This shortfall is what is getting adjusted now. Probably this will take a little longer time to adjust, because the excesses were very high, and that's how the market adjusts to all the excesses. Once in every 5 years, we have this euphoria building up in the market, and the rest of the 4 years will adjust. Some years can be negative also. So is it going to be a negative year the coming year? Are we going to see a crash? Again, absolutely not. There are a couple of reasons for that. One is, the whole world is chasing India today. Somewhere around 70,000 to 1 lakh crore of money is coming into the markets every month. SIP book size is talked about 23,000 crores. Of course, there are some nuances there, some cancellations have been going on also. So this much money is chasing the market. A small drop, everything is bought, and again it's going up. That's why every week we are seeing a new high getting registered, but that new high is just a small percentage, very, very small percentage, and again it drops. So that's where from the 60% we have come to 20% now. But big correction is not likely. And why it will not go up? Again, we said this profit pool that is not growing as expected. So profit is there. The growth percentage is not as it was in 2023. Again, COVID years, the lockdown coming out of that, and that all also created this higher growth percentage, which is not going to come up again. Probably a couple of quarters it will take to adjust, balance out base, and then start going up. This is the reason it might not go up and not come down also. So what should be the expectations for the coming months from now? Surely we are not going to repeat 2023. markets have already started adjusting to the higher gains, bringing it to the lower side. So our expectation should be somewhere around double digit numbers. In this chart, we can see there in the last 1 year period, that is from now prior 12 months, the broad market was having around 40% returns, and here we can see one very big bar, that is the PSU segment of the market, which gave close to 100% returns, that is in the last 1 year period. When we come down to 8 months, from January 24 till August 24, the 8 months period, we can see a big shift. Overall market return has dropped to 20%, and the PSU segment from 100% it has come to 40%. It's drilled down 60% returns. Mid and small caps also have corrected almost 30%. The returns, percentage returns from 60 it has come to 30. As we get closer, even closer to 6 months and 3 months, it becomes even more downside. Large caps, that the whole market has come down to single digit, even mid and small caps have come down to single digit, while we can see some spaces like FMCG, technology and pharma giving close to 20-25% returns in the same 3 month period. What this shows is, though the market is drilling down to lower returns, there is pockets where we can have exposures that can help us to make or reach the same kind of returns what we made in the previous, that is in 2023. Our last video in June 2024, we had discussed about investing in 5 themes and sectors, that is FMCG, technology, services, MNC and automobiles. This actually worked out very well. From June till now, out of the 5 segments which we talked in that video, 3 have done extremely well. Technology was the superior in that it made around 20+%. FMCG and pharma, FMCG and financial services have made around 15% return. In the same period, market return is only 7%. So by having this exposure, our average return will go up. Of course, all the 5 did not work. 2 MNCs and autos are going through challenges. So what this shows is, even though market return comes down, if we are able to participate into those segments where opportunities are higher for profit making, that will help us to have the same kind of returns. But expectations should be brought down. We can't have the same expectation of 30-50% returns. Have expectation at around double digit, probably 10-12%, and 3 or 4% additional returns by participating into the sectors and themes that are always giving opportunities. And today in India market, we have lot of new themes coming, factors coming, which are giving us opportunities like 20-30% returns in 6 months time, and we have to enter it in the right time and exit at the right time. Those studies we keep doing regularly, and that is what we are generating these videos. So what are the challenges for the market in the coming months? We had many, out of the 2 got over. India election results and the budget, which was expected to have some negative surprises, did have negativities coming up, but market kind of brushed off all those negative surprises just like dust in a big tide. Well, now we have the bigger global picture. US election results in November, China dumping excess production into the global world, which is already started creating problem to bigger economies. Companies are shutting down, and this is going to have a spillover effect into India also. And the bigger threat is jobs. Jobs data has been very threatening. This is likely to make all the countries start working on how to tackle this. One of the ways they will do it is by cutting down interest rates. So interest rates on bank deposits is likely to come down. I think in a day or two, US will start. Once US triggers, India also will start that. When that happens, it will be a threat for emerging economies, because money will move away from emerging markets to developed markets. So one side, some are getting over, market is not taking consideration of that, while there are a lot of things which are in line to be gone through. We have to see how this works on. So what actions can we take to address these challenges that is going to be seen in the coming months? Stock market returns are likely to grind down to lower returns, that is lower double digit returns, which we had already talked about, while the cut in interest rates is going to make debt market, the bonds, very, very attractive. We had talked about bonds as an investment in April. It's 4 months now. In the 4 months, bond returns have been 5%. In 4 months, 5% returns. 5% in 4 months might not look very, very attractive for us. We are still rejoicing the 30 to 50% returns that markets gave in 2023. But very soon, in next 6 to 9 months time, as the stock returns grinds down to single digit, then this 12% will become very, very attractive. The advantage here is when stock returns at 12% is going to be a bumpy ride, bonds will go through a smooth sail. That is, it will not have that much downside. So, choice is ours whether we want to go through a harsh up and down movement, tired journey to reach the 12% target, or make it a smooth sail, reach there 12% healthy, and be ready with activity to participate in the next opportunity that is going to come in the market. For those, we are suggesting that 5 to 10% of profits can be booked from mid and small cap and moved to bonds, so that our journey from here is not so bumpy. We are not going to take out all the money because that will attract a lot of taxation, and who knows, our decision might be wrong also. So, if you are wanting to participate in the bond transition, please let us know through a mail or WhatsApp message. We will do the transactions for you and move a small portion of your holdings from mid and small cap to bonds. Once again, wishing all our members bonding festive season along with bonds. Thank you.